Tai, let me get you started with our question of the day from our MLive blog, which is really asking, does this global energy crisis guarantee stagflation? And the thing is, it's not just oil, right? It's also natural gas hitting these new highs. It's coal, it's iron ore, it's lumber, it's food prices at a decade high as well. Does all of that add to what you would characterise as a high risk of stagflation, and does that change your investing strategy?
Well, I think in the near term, what you could see is acceleration of inflation on the back of these energy prices, commodity prices. And meanwhile, the COVID and related issues creating a bit of a slowdown in the economy. So optically, you could see the divergence of inflation and growth. But I think in the longer run, don't forget the fact that we're still in the recovery phase of the global economy. I'm expecting Asia to join in 2022. So while inflation is still a concern, I don't think that we are necessarily running into a stagnant growth or recession scenario. So I'm not that pessimistic about the threat of a stagflation in the longer term, which would be 6 to 12 months from now.
A lot of it depends on where the consumer goes, right? In the US, we're hearing from Morgan Stanley Wealth that they're worried about the increasing gap between consumer sentiment, which we know has fallen since the peak in July, and how investors seem to be perceiving Delta and the economic recovery. When does that start playing into earnings expectations if the consumer side continues to lag?
Well, I think a couple of things to bear in mind. First of all, if you look at the COVID situation, the US infection numbers are starting to come down. Of course, we're running into winter months and that could change, but overall the trend is still rather positive. And secondly, don't forget, if you look at the job numbers, although last Friday's job numbers were disappointing, the wage growth continues to accelerate. So I think from that perspective, while the COVID news may not be particularly cheerful for consumers, at least on the wage front, things are looking reasonably robust. I think that will keep the consumer spending going, even though the sentiment data has been consolidating.
We have seen the dollar also continuing to rally. We are talking about the most bullish bets by hedge funds in about 2 years or so, as this GTV chart on the Bloomberg shows. Your notes say that you are now more interested in Asia and EM, so how would a stronger dollar factor in?
Yeah, no, definitely. I think in the near term, a stronger dollar boosted by higher yields, maybe a little bit more concerns about global growth. I think all of which does call for a more bullish dollar in the next 3 months or 3 to 6 months. But nonetheless, if we do get a rebound in the Asian economies when vaccination rate goes up and the infection numbers are coming down, that ought to be good news for Asian earnings. And yes, typically the strong dollar doesn't encourage flows into Asia in emerging markets. But in fact, if you look back to the past 3 to 4 months, we have seen inflows into parts of Asia, for example, India, Indonesia, despite a stronger dollar. So if we get a weaker dollar, that's even better for Asian assets. But even with a more bullish case in the US dollar in the near term, I don't think that will stop the show for Asian equities.
Not only inflows, but also outflows from the likes of South Korea and so forth, right? We are getting the BOK rate decision. We are seeing more central banks across Asia starting their tightening cycle, including the RBNZ. How does that factor into the markets? Well,
I think Bank of Korea and RBNZ are at this point still the exceptions rather than the rules. If you look at other central banks around the region, for example, the Reserve Bank of India is slowly, very slowly, looking to normalize its policy, but far from raising interest rates. China, because of all the economic difficulties right now, I would expect them to be more accommodative. And then for the rest of the region, it's very much staying put until they have a firmer hand on the economy, where we see domestic demand really start to rebound, hopefully in the first half of next year. So I think overall, the rates environment, both in Asia and globally, is likely to stay very accommodative, with the exception of a couple of central banks.